Then let's continue the transaction analysis by finalizing with this financial statement creation. We are going to create this balance sheet, income statement, and retained earnings statement based on the transaction analysis with journal entry, general ledger, and trial balance. Okay, as you can see that I already listed the name of account on the assets, liability, and equity that are related to this transaction. So let's put using this general ledger. The reason why we create this general ledger is that we wanted to find the balance of cash, balance of all the accounts on the balance sheet and income statement as well as the retained earnings statement. Okay, let's start. Okay, balance sheet on the cash amount. Now it is simple. We collect only the balance of cash, the final balance, the last balance. Then account receivable 2,000. Okay, pretty simple. Then we can trust this amount because we found this trial balance, the balance between the debit and credit, which is balanced out. We collect all the information. Okay, and then lend 18,000, and then equipment there's 700. So the total asset account, we wanted also the double check between the asset and liability equity. Asset is equal to liability equity. Okay, so 57,000. So liability plus equity should be the $57,000 as well. So accounts payable. Now accounts payable, we have a balance, the liability 1,800, and then the common stock. On the common stock 50,000, and then retained earning. Oh, retained earning minus 2,100. But we want to finish this retained earning statements. This ending balance of retained earning should be linked into this retained earnings on the balance sheet. Okay, so let's leave it here. Just leave the blank for a while. Now the sales revenue. The revenue the company generate of the year is 10,000. Operating expense. Now from this we should put the negative 27. Okay, do you see this parenthesis? The bracket means the cash out. Okay, but the rule of this journal entry, you can see that there's no negative value. There's no negative value because we can use the other account, the side, the balance like debit and credit. That's why we use these two, the double accounting, right? Debit and credit. But here on the income statement, we see this expenses, which is negative. Then net income. Okay, the net income is now sum of all this. So 7,300 is net income. Now the beginning retained earnings is 0. Why? Because the company just gets started their business this year, April 1st. Then net income is added to 3,700. If the company has been operating for 30 years or 3 years, they should have this retained earnings certain amount, which is the accumulation of all the net income. But there's no. So anyway, because there's no beginning retained earning, we started with this net income the company generated for the first year. So 7,300, and then dividend. Now finally we put the dividend, this 2,100, that reduced the retained earning. So that's why we put this retained earning related to dividend. We recorded on the debit side, 2,100. Then we found the ending balance of retained earning is 5,200, right? Now this retained earning of the ending balance, because as of December 31st of that year, should be 5,200 after subtracting this dividend. And then the sum of this all the liability and equity should be the same as the total asset. Now we finally finished this project game financial statement. Okay, the last step is closing entry of the income statement accounts, because now all the income statement value transactions are now collected into this retained earning net, because net income is including all the transactions of the sales or the expenses, right? So we have to remove these transactions related to sale, the income statement. Anyway, because we put this all the balance on the balance sheet, also this retained earning is including this income statement transaction as well. Okay, so how do we remove this income statement account transaction that is not necessary to be remained? So on the debit, we want to remove all the revenues or gains on the income statement. The reason why we put on the debit is that we want to remove on the revenue or sales or gain on the credit. By putting debit, we can remove all these transactions. So how much was that? Okay, there you go, $10,000. Then we can just write down income summary. This is just a temporary name of account. Income summary. It's the same amount. Anyway, we'll remove this income summary at the end of the day. Here, income summary on the debit side, that means that we want to remove all the expenses, right? Expenses and losses. If you have all the expenses and losses, how much was that? Right, there you go. Income statement, we only have two income statement account. 27, so this summary is 27. And then we will get this retained earnings, because retained earning 5200 increased. How do you get this? 52, how do you get this? Income summary 10,000 and income summary 2700, right? 2700. So retained earning, how to get, how to get it? First, here, income summary will remove 10,000 minus 2700. So 10,000 minus 2700, so that we remove all the income summary, and then this all the revenue and gains and all expenses and losses now removed by putting the other side. And then retained earnings we increased by, right, 7,300, which is the same as this. And then we will reduce this retained earnings by 2,100. Why? We pay the dividend, right? Dividend 2,100. So we reduce this retained earning by 2,100. Okay, then we closed all the income statement account, including this dividend. Okay, that's it. See you guys in the next video clip. Bye bye.